What if I told you there's a single number that can make or break multi-million dollar deals? A number that separates a brilliant investment from an absolute disaster. Well, today, we're going to decode what might just be the most important number in all of business, the cost of capital. So to really see this in action, let's meet Sue Payne. She's the CEO of Tasty Bread, and she's got a huge decision on her plate. She wants to spend $250 million, that's 250 million, to get into the jam business. Her team says they can expect a return of about 7.5%. The question is that any good? I mean, how do you decide? A gut feeling isn't going to cut it when that much money is on the line. What Sue really needs is a benchmark. She needs a minimum acceptable rate of return for this specific kind of investment, with this specific level of risk. In the world of finance, we call this the hurdle rate. And it's exactly what it sounds like. If the project's return can't clear that hurdle, then it's a no-go, plain and simple. And guess what? That hurdle rate is the cost of capital. Now, here's the absolute key. It's an opportunity cost. This isn't about how cheaply your company can borrow money. No. It's about the return your investors, your owners and lenders, could be getting somewhere else on an investment with the exact same amount of risk. It's the market basically looking at you and saying, hey, this is the minimum you got to pay us to take this kind of risk. And to really get this, you got to think of a business in two parts. You've got the real side, the factories, the stores, the actual operations that make the money. Then you've got the financial side, which is just the claims on that money from your debt and equity investors. The risk of that real business has to be completely absorbed by those folks on the financial side. Okay, so how do we actually put a number on this idea? Well, the most popular tool in the shed for this is something called the weighted average cost of capital. Yeah, I know, it's a mouthful. We call it WACC. Let's break down what it actually is. And listen, WACC isn't just some dusty old theory from a textbook. It is the standard tool used everywhere, from Wall Street trading floors to Silicon Valley boardrooms. It's how you turn this fuzzy idea of a hurdle rate into a cold, hard number that helps you make real decisions, just like the one Sue is facing. Now, don't let the name scare you off. The whole idea is actually pretty simple. A company gets its cash from two main places, right? Lenders, which is debt, and owners, which is equity. Each of those has a different cost. WACC just blends those two costs together based on how much of each the company is using. That's it. It's just a weighted average. And this is such a great way to picture why that blend is so important. Think about it. The people who lend you money, the debt holders, they have first dibs on the cash, so their investment is way less risky. The stockholders, the equity owners, they get whatever's left over, which makes their piece of the pie much, much riskier. The WACC lands right there in the middle, perfectly representing the total risk of the business operations themselves. All right, so WACC is a blend of the cost of debt and the cost of equity. Simple enough. But how do we figure out the cost of those two ingredients? Let's dive in and calculate them. We're going to tackle these one by one. The cost of debt is actually the more straightforward of the two, so let's start right there. The most important word on this slide is today. Seriously, we do not care about the interest rate on some loan the company took out 5 years ago. That's history. We care about the opportunity cost. What rate would a lender demand right now, today, for a brand new loan to a company with this exact risk profile? That's the real, current cost of debt. Now, the cost of equity, that's a little trickier, right? I mean, unlike a loan, there's no interest rate stamped on a share of stock. Shareholder returns are totally uncertain. So to solve this puzzle, we turn to one of the heavy hitters of modern finance, the capital asset pricing model, or KAPM. And at its heart, KPM is built on an idea that is so simple, so intuitive, you already know it. It's just this. If you want me to take a bigger risk, you better offer me a bigger potential reward. That's all it is. This chart shows it perfectly. Your expected return is made of two pieces: the return you get just for waiting and an extra kick, the risk premium for taking a gamble. So CAPM takes that simple idea and turns it into this precise formula. I know, it looks a little intimidating, but it's really just 3 simple building blocks that measure that risk-reward trade-off. So let's break down those building blocks one by one. First up is the risk-free rate. This is your foundation, your baseline. It's the return you could get on an investment that's considered totally safe, like a U.S. government bond. You get this return just for being patient, without taking on any real risk. It's the starting point for everything. Okay, so we've got our foundation. Now, on top of that, we add the market risk premium. This is the bonus. It's the extra return investors demand just for taking on the average risk of the entire stock market instead of just playing it safe with that government bond. You could say it's the price you pay to play in the big leagues. And finally, we have beta. This is the magic ingredient. Beta is what makes the whole formula specific to our company. It just measures how much a stock zigs and zags compared to the overall market. A beta of 1 means it moves right in lockstep with the market. But a beta of 2, that means it's like the market on steroids, twice as volatile. It tells us exactly how much of that market premium our specific stock deserves. All right, Siri lesson is officially over. Let's get back to Sue Plain at Tasty Bread and her $250 million jam problem. Now that we have all the tools, we can finally figure out the correct hurdle rate for her new venture. So her analyst does something really smart here. He doesn't look at Tasty Bread's cost of capital. Why? Because they're in the low-risk bread business. Instead, he looks at the WACC of companies that are already in the jam and jelly business. These companies, Sugarloaf Mountain, White Oak, Moose River, they give him the right benchmark for the specific risk of the project they're thinking about. After digging into these comparable companies, Ben lands on a final number. The appropriate cost of capital, the true hurdle rate for an investment in the jam and jelly industry, is 8.0%. And now we have the moment of truth. The project's expected return is 7.5%. The hurdle it needs to clear is 8.0%. It falls short. You see, even though it looks profitable, this investment would actually destroy value for the shareholders. Why? Because they could take that same money and get an 8% return somewhere else for the exact same amount of risk. The decision is crystal clear. This is a bad deal. And that is why the cost of capital is so incredibly powerful. It forces financial discipline. It makes managers think like outside investors, and it stops them from just chasing pet projects or trying to build empires with investments that just can't clear the market's bar for risk. This quote from the source material just absolutely nails it. The key thing isn't where the money's coming from, in this case, the safe bread company. What matters is where the money is going, to the riskier jam business. The hurdle rate has to match the risk of the new project, not the old company. You know, this idea isn't just for giant corporations. Every big decision we make, changing careers, buying a house, making a personal investment, it has an opportunity cost. It has a hurdle rate. And that brings up a pretty good question for all of us, doesn't it? For your next big decision, what are the alternatives you're giving up? And are the potential returns really worth the risk?